Hi, everyone. Good afternoon, and welcome to the next in our Essentials series with the Dura Society. I am evidently not Lottie. I am Jess Miller. I'm a committee member at the Dura Society and founder of investigations boutique Australia Advisory, and I am subbing for Lottie today. At the Dura Society, we explore what wealth means to modern women by providing them with the financial and legal knowledge to take control of their wealth and well-being with confidence. The theme of today is opportunities and pitfalls when investing as a US connected person living in the UK. If you hold a US passport, a green card, or are simply married to someone who does, your relationship with money is more complicated than most people's. Living in the UK while connected to the United States creates a financial life that sits between two regulatory systems at once, and those systems were not designed with each other in mind. In this conversation, Olivia Burke, Associate Portfolio Manager at Brown Advisory, will take us through the landscape as it actually stands, what the investment constraints are, what the common mistakes look like, and what a well-structured financial life can look like for a US-connected woman living in the UK. Please note, bit of housekeeping, this is for education purposes only, and if you do have any questions, please feel free to reach out to Olivia and Brown Advisory directly. So with this in mind, let's go. Olivia, thank you for joining us today, and it's over to you with the presentation.
Oh, thanks so much, Jess. And thank you and welcome everybody who's dialed in today. I'm Olivia Burke. I'm a portfolio manager at Brown Advisory. I have been at the firm for nearly 5 years. I joined as a portfolio analyst, and during the last 5 years, I have spent my time building expertise on the topic that we're going to discuss today. So I've been learning about the US tax system and how it interacts or doesn't interact with the UK tax system and the knock-on effects for UK resident investors. About 80% of my clients have some sort of connection to the US. That is mostly Americans living in the UK, but also sometimes Americans living outside of anywhere of the US, or just UK individuals who, as was mentioned in the introduction, have managed to marry an American, which has complicated a number of their affairs. So that's just a little bit about me, and then I'll just quickly touch on the firm. For those of you who have not heard of Brown Advisory, we are an independent investment management firm. We were launched in 1993 inside America's oldest investment bank, Alex. Brown & Sons, where we were managing money for the Brown family. In 98, the partners led a management buyout, and we have been employee-owned and independent ever since. In 2008, which is a brilliant time to launch a business, a financial business, we launched our international offering based out of London, which is where I am today. And a few years later, that offering, which had initially been established to distribute UCITS strategies, was extended to a private client offering. And that is relevant because the reason why we began that private client offering is for this exact purpose. It was an observation that Americans living in the UK were underserved with investment advice, and there was a gap in the market that we had the expertise and regulation to fill. Since then, we've grown considerably, and now the private client offering in outside of the US manages investments for all sorts of private clients, but I have obviously stuck with the original intention of the international business. And as I said, the majority of my clients are connected to the US. So today we will touch on a number of tax, legal, and investment topics because they're all sort of interlinked when you're discussing Americans in the UK, but we will try to always anchor and focus it back to the investment side. I'm not an accountant. I'm not a lawyer. My expertise is specifically in investments. So if we just begin by pointing out exactly why it is that this is a complex topic. So what has been consistent and remains unchanged is that the US taxes all of its citizens and green card holders on a worldwide basis. There is only one other country in the world that does that, and that's Eritrea. In addition to this quite unique method of taxation, the US has very strong integrated relationships with the global banking system, which means that they are able to maintain information about citizens living abroad, and that banks abroad need to report to the US tax authority. The UK, on the other hand, and this is part of the recent changes, has recently changed so that it will tax resident taxpayers on a worldwide basis. So this is different. This isn't citizens, but if you are a tax resident in the UK, your assets are taxed whether they are physically in the UK or abroad. It was already quite a complicated system to begin with, and then policy changes have added to that complexity. In addition to the change from the UK remittance basis, an additional change is UK inheritance tax. So it's shifted towards a long-term residence framework, which means that if a person has been a UK tax resident for 10 of the last 20 years, they choose to leave the UK, they will still be within that UK inheritance tax net for between another 3 and 10 years. So that's quite relevant when you consider, specifically for Americans, for example, if they chose to leave the UK and return to the US, where there's quite different allowances for tax-free amounts on death, they could still have some of their assets sort of clawed back into the UK tax system. All that is to say that even if you get really, really comfortable with your investment plan as a UK-US taxpayer, it does need careful and deliberate and frequent review, because these are moving parts. The US regime doesn't need to speak to the UK regime before it makes a change, and they frequently obviously don't bear each other in mind. So if we dial in on the investments, this is an imperfect but broad framework of what investments and structures are likely suitable for somebody who is a US and UK taxpayer. So we can see we've got the UK tax efficient products and structures and the US tax efficient structures, and then in the center where it intersects, that's sort of where a portfolio would live. Now, there are a couple of things on this list that we'll dial into in a little bit more detail later on, just based on the popularity and the common misconceptions. But I've just highlighted a couple to touch on now because these are slightly surprising. So mortgages on your UK property, it's not, the mortgage aspect isn't really considered an investment product. Something that you do have to bear in mind is that if the FX rate moves whereby in dollar terms you have made a gain in repaying your mortgage, that is a taxable gain in the US. It's quite an unusual one. Another one is EIS investments, where in the UK you would get a tax break to support smaller domestic businesses. The US doesn't recognise that, so you would not receive it on the other side. And you might also notice that a couple of things appear on both sides of the list, and that is because some things can be suitable in one jurisdiction and also in the other jurisdiction, but not in both jurisdictions at the same time, which I'll discuss in a second. So here's a few questions that we can ask ourselves before we sell or change tax residence or make an investment decision. So is it efficient from a UK perspective? Is it efficient from a US perspective? And so these are both from a tax and regulatory perspective. And then the point that I just made, are they efficient from both a US and UK perspective at the same time? So an example could be a US LLC. These are both potentially efficient in both jurisdictions separately, but because the LLC can be taxed based on its profit and the UK could tax it based on the distribution to the owner as a dividend, these two taxable amounts don't net off with one another. So I actually don't think I mentioned this, probably quite relevant. The US and UK has a tax treaty. So the intention behind that is to avoid double taxation on the same asset. It doesn't work where the income or gains or distribution arising from these products aren't defined in the same way. So as I said with the LLC, if the UK considers something dividend and say the US considers something else a corporation profit, there's nothing to net off. You can't take a credit, you can't claim you've already paid tax on it because they're not the same thing. So look at it through each lens and then look at it through both lenses. The next question is the asset or legal vehicle suitable for this account? So not all account types are the same. Your SIP, your self-invested pension plan, is different to your taxable brokerage account, is different to your ISA account. Different accounts, in addition to the concerns you have about tax, different accounts will have eligibility rules. So if you want to buy an asset, you also need to think, set a third circle of the Venn diagram. Does it make sense in this account? And then a consideration is, could it be best placed in this account or in another account? So something might be suitable, but you actually might get a little bit more bang for your buck by putting it elsewhere. An example could be in ISAs, and we'll talk about ISAs a little bit a few slides over. But an ISA for a US person living in the UK only really works with single stocks and bonds. The way that you get the most use out of it is to put stocks in that generate US qualified dividends. And the reason for this is that you get the tax break on the UK side. So the UK doesn't tax anything in that pot of capital, gains, distributions, it's not going to tax anything. But the US doesn't recognize that tax wrapper. So you get a benefit where the tax rate in the US is significantly lower than the equivalent tax rate in the UK, which is why qualified US dividends make sense there. So is it suitable? And can I do better? Can I allocate this more intelligently? So not only is it okay, it's actually being helpful. The next question is, can I access and custody it? One of the most suitable asset types for US, UK people is US mutual funds and ETFs that have something called UK reporting. These are tax efficient from both perspectives and they're taxed with the same view in both regimes. The biggest issue is access to them, because a lot of the issuers don't have the right to distribute them in the UK. So you go on your platform where you're buying funds and you just might not be able to find them. Custody, similarly, a lot of US pension accounts have to be custodied onshore to the US. So if you want to move all your assets into the UK, you might find that a particular account or investment isn't portable. That doesn't mean you can't manage it, but the provider of the plan in the US might have an issue with people who live outside the US having investments with them. So there's a sort of operational and infrastructure complexity to it. Next question is, can I report it properly to both tax authorities? This is one that catches people out. So regardless of whether or not you owe tax in the US, you still do have to disclose your accounts and the investments in them. In order to do that, you need to be able to produce reports that are sort of digestible to the US. Now, the obvious way to do this is a specialist advisor, a US UK accountant, or just a US accountant. But even when you're providing them with the information, you need to make sure that you have the appropriate cost basis of that asset for the US regime. So that obviously is the cost in dollars at the time that you bought it. And then something called tax lots, which if you're not familiar with, it is a different way the US views the cost of an asset. So if you've bought 5 shares in Meta in 2021 and then another 10 shares in 2023, the cost is not a weighted average. It's the amount that you bought at that date, at that cost, in dollars, at the equivalent FX rates, added to the same formula for the next purchase. Whereas in the UK, it's a weighted average. Maintaining those, particularly years and years after you've started investing, can be quite difficult. Unpicking them can be quite difficult. So if you want best practice, try to do it from the very beginning. Ideally, your provider can produce these reports or your investment manager. But if you are trying to do it independently, do a little bit of work to figure out how you can maintain those on your own personal records. And then the final one, which is where people in straightforward tax situations get to begin, is, does it meet my goals, and is it actually a good investment? Just because you have a narrower investment universe doesn't mean you should settle for rubbish. There are still lots of really good options, and you shouldn't sort of be crowbarred into going into something that is not suitable for you, doesn't achieve your goals, and doesn't perform. Okay, so what's investable? This is a sort of broad framework of the, in inverted commas, safest options for most retail investors. Now, there are other things that you can invest in, and there are some exceptions even to these rules, which I've tried to outline in that final column. But this is a good guidance. So direct equities and direct bonds, both of those will be suitable in almost every account. They will be taxed similarly in most accounts from either jurisdiction. The downside is obviously access and selection. So most people who aren't professional investors don't feel motivated, confident, enthusiastic about selecting individual stocks. It takes a level of interest and it's incredibly time consuming. You do need to develop expertise in portfolio management and equity research in order to sort of successfully select equities. There's opportunities where you can follow well-known investors who share their thought process. But it's a bit of a gamble to do something that's that sort of technically complex without experience. Access, as I said, could also be an issue. A number of platforms, if you're self-investing, won't provide you with access, particularly to individual bonds, mainly due to liquidity, and there's some risk issues as well. So you have to find a platform where you can access them, and then you have to be confident and comfortable that you can maintain that level of research and portfolio monitoring. Obviously, the best solution, where possible, is to have a professional manager do it on your behalf and pay for that service. The next two options are pooled opportunities. So US funds and US ETFs that have UK reporting. These are probably the best option for someone who is investing for themselves, who is US UK. The reason for that is that you can get very broad, diversified exposure to large markets, which doesn't require huge amounts of expertise. So you can get, for example, a global equity tracker which tracks the market, and that will be suitable in both jurisdictions from a tax perspective. Again, the issue is access. So you have to find a way to access those. Most commonly, the easiest way to access those is to have a professional investment manager who has access to the US market. The next one is PFICs or PFIC reporting. This is slightly different because these are the funds that you can access in the UK that have the right to be distributed in the UK, and they're what most UK only taxpayers are invested in sort of passive accounts. It's what, if you have a Monzo or a Revolut account that sort of sweeps your money into funds, it will be these types of funds. There's nothing wrong with them, but the way the US reports on them and taxes them can be incredibly punitive. If they have something called PFIC reporting, which a number of them do, that can help technically over a long period of time, people who own a PFIC reporting PFIC who are paying tax in the US should not actually pay any more tax than if they owned the equivalent strategy in a US fund. But the issue is to file the PFIC report with the US tax authority can be of material cost. There are some platforms that offer ways to do it very cheaply, where you can do it on your own, which is obviously a risk if you don't have that sort of expertise. To get a really, really good accountant to file them could be $1,000 plus. So if you have a $50,000 account and every single year you're paying $1,000 to file this report, and maybe you have more than one PFIC, maybe you're paying $3,000 to file a report, obviously that doesn't make sense. We have to always consider on every investment basis, the cost or the return is net of the tax cost, the trading cost, and the accountancy costs. And the downside here is that the accountancy costs are quite pricey, or can be. And finally, cash and deposits. Obviously, this is not where most people want all of their investments. You're not going to get any sort of or much real return in most scenarios. Hopefully, you get some return, likely not keeping up with inflation, but it is safe. The only thing to watch out for is money market funds. A lot of opportunities to hold cash with high interest or hold cash on deposit. There could be underneath that platform that you're seeing, there could be a money market fund in the background that is generating that interest. And anything in the UK that you can buy on a normal UK platform will very likely be a PFIC if it has the word fund anywhere in it. So watch out for those. Okay, so this slide is just talking about how you can be incentivized to invest in a structure or an asset because of a tax benefit. And you have to be aware that the tax benefit doesn't always travel. And in fact, more often than not, it doesn't travel to the US tax authority. So the examples that we've got here are the ISA family and gilt and qualifying corporate bonds. So in the UK, and this is probably one of the most common questions that we get asked. In the UK, obviously an ISA is a tax-free account wrapper. There's 3 different types. There's regular ISA that all adult taxpayers, tax residents in the UK can have. So that's £20,000 contribution every tax year that can grow and generate interest and return without any tax consequence. There's the JISA, aka the junior ISA. That's the same thing, but for under 18s. That's £9,000 contribution. And then the LISA, or the lifetime ISA, where you can contribute £4,000 a year. And every year, the government will top up 25% up to the value of £1,000. Again, grows tax-free. So the US does not recognise the ISA family. It doesn't recognise them as tax-free, and it sees them just as any other normal account. So you need to pay tax on the returns. You need to declare the underlying holdings. So in that regard, you need to make sure that they are US efficient from their tax perspective. You have to maintain US cost basis and tax lots. The solution, or the option that you have, which I mentioned earlier, is to buy single stocks or single bonds or have some cash in one of these wrappers and try and benefit from the dividend tax differential, or generally the tax differential. Though typically the US tax rates will be slightly lower than the UK. So there is some benefit to holding them. Your global effective tax rate can be lowered compared to if you'd just done the same investments in a regular brokerage account. The issue can be that providers of ISAs, so the platforms, because they are aware of this issue, when you try to sign on and declare that you are a US citizen or a green card holder, they could instantly just block your application because they don't want to have to deal with the complexity, or that they can't produce the necessary reports. So the most common way to do it is to find an ISA platform that allows you to self-direct all the investments. And then obviously you can select the bonds and equities that you've researched. The UK gilts and qualified corporate bonds issue, again, these are perfectly suitable from a US perspective in terms of tax efficiency. They're not punitively taxed, but there is taxable benefit in the UK to holding these. So the gain on both of these types of fixed income products is tax-free to UK tax residents. Again, the US does not recognise that tax benefit. Now, the problem is with that is that because this tax benefit exists in the UK and these trade on a sort of primary UK market, the yield of these types of products will be slightly lower because people are trying to buy them because they want the tax benefit. If the yield is slightly lower and you're not getting the tax benefit because you're paying tax on it in the US, you have to question whether or not these are the best products for what you're trying to achieve. It may be that they still are, but it's just worth mentioning. Similarly, on the flip side, on the US side, municipal bonds, which are at the bottom here, these are basically the same situation, but the other way around. So US municipal bonds have US federal income tax-free, and if you buy bonds that were issued in your home state, then they may also be exempt from state and local tax. The UK does not recognise this US tax benefit. And again, they typically trade at a lower yield because more people are trying to buy them because they're trying to benefit from the tax benefit. So is it still worthwhile to own those products when you're going to be fully taxed on them anyway, and you could just buy a similar product in that asset class that's producing a higher return? And at the top, 529 plans. So these are tax advantaged education savings accounts, and often they are funded by grandparents for grandchildren's education. The UK doesn't recognise that tax benefit. Potential consideration, a potential fix to maintain the tax advantaged capital within that pot is you can change the beneficiary. So say, for example, grandparents are still in the US, you have moved to the UK or had a child in the UK, they can change that beneficiary, which will reduce the reporting costs and hopefully maintain the tax advantage savings. Okay, so other things to consider are timing and ownership. So the timing can absolutely catch people out. The US and the UK have different tax years. So if you are realizing gains in a portfolio and you're trying to spread it out across the US and the UK regime, you have to remember that they run differently. The US tax year is the calendar year, and then obviously the UK tax year is April to April. The other thing to consider is even if you are maintaining tax lots, as I mentioned before, and as well as the weighted cost average that exists in the UK, the FX is relevant. You can have an asset that is at a gain in one currency and a loss in the other. So don't assume if you sell something that there will be no bill because perhaps in the UK it's trading at a loss. It could be trading at a gain in the US or vice versa. The US also differentiates between short and long-term gains. So if you sell an asset within 12 months of buying it, the US regime will tax at a higher rate than if you'd held it for longer. So consider timing. Also, UK CGT, this is the tax-free allowances has reduced over the last few years, but you do still get an allowance in the UK for realizing capital gains. Don't get that in the US necessarily, so just something to bear in mind. Gifting, the US and the UK have different rules for gifting, exclusions, lifetime inheritance, lifetime exemption fees. You need to know both of them, and when you make a gift to a family member, a spouse, or when you're getting your will written, you need to bear these in mind. You might think that you have all your affairs in order on one side of the pond, and the other side of the pond, it's not aligned to. Donations, these can be a really good solution where you've got embedded gains, you would like to use a charitable donation to get a tax break. They can be a great solution for people who have accidentally bought PFICs and held them for a long time, and they've got such a large gain that the tax will be enormous. But you need to check that the donation will be dual qualified, i.e. it will qualify for a tax advantage on both sides of the pond. And if it's only going to be one side, make sure it's the side that you are trying to fix the problem for. Both regimes have different rules about what the definition of a charity is and what criteria the asset within the donation must fill. So always worth doing a little bit of research and getting some advice on that. And finally, with timing and ownership, if you are a US and UK taxpayer who has perhaps a UK spouse and you do share financial affairs and share money, you should consider a household balance sheet, because this allows you to view the allocation of your combined portfolios through the lens of what is allowed for one person and what is not allowed for the other person. So you can seek allocation to maybe a product that a UK-US investor can't buy by holding more of it in the name of the UK-only spouse. And the other one that I've put in capital letters, the remember, because this comes up a lot. It's not necessarily to do with investing, but just always worth bearing in mind. If you are a US citizen and you have a child, in most instances, that child will also be a US citizen and US taxpayer, even if you've never applied for their passport, acknowledged their existence to the US government. Becoming a US taxpayer is not based on owning the passport. So a lot of people think I can move assets into my child's name, or my child can own certain things, and then the child turns 18, discovers that they are a US citizen and US taxpayer, and they've sort of begun their adult life in already quite a complicated investment and tax position that requires quite a lot of advice. So just consider that. And if it's a mistake that you've already made, sort it out sooner rather than later. Okay, so just to recap, 5 questions to think about before investing. How is the account or the investment tax in each country? And that should have it afterwards, and in both countries at the same time. Was I incentivized by a tax advantage? And does this advantage exist in both jurisdictions? If it doesn't exist in both jurisdictions, has the tax advantage offset any of the return, and is it still worth it? Is the investment suitable for and best placed in this type of account? Can I get more bang for my buck by allocating this to a different account? If I've got a SIP, an IRA, a pension, an ISA, how can I allocate intelligently so that I get the best possible tax treatment? Number 4, what happens if I move, gift the asset, retire, or die? Always consider flexibility into your investment plan. A lot of people think, well, I'm never going to go back to the US, or I'm never going to leave the UK. Life happens. So if you're getting professional advice, it is always worth asking what would happen in X scenario, what would happen in a 10% likelihood scenario, certainly what would happen in a estate planning after death scenario. That's incredibly important. And finally, am I suitably advised, and do my existing professional advisors have sufficient expertise in both jurisdictions? There are a lot of scenarios where people have legacy relationships, maybe through family members, maybe through their personal network, where somebody is managing an aspect of their affairs that doesn't have the appropriate expertise. So, for example, there will be people who have an accountant in the US who maybe they've met once, and an accountant in the UK who happen to also be a family member's accountant. Unless both of those people are speaking to one another, or there is somebody sat in the middle who's very well educated on how to connect these things, that is likely not suitable, particularly as investments grow. Consolidation is most often a good solution for US, UK people, because all of these different pieces need to speak to one another. Okay, so we had some questions and we just picked 4 of them that were most common and that I see my clients and new clients asking. So the first one is people in a full-blown panic saying, I'm 15 years in and only just discovered this, and I have an ISA full of UK funds and no FBAR filings. This also applies to people who didn't realize that they were American. So the baby that I mentioned earlier, whose parents have never got them a passport, they can often also be adults who never truly had it explained to them that they were a US taxpayer. So first thing is, don't panic, and don't rush to transact. The natural reaction, I think, for a lot of people is to just hit sell or send a sell instruction and hope the problem disappears. Whilst that may work, it also likely won't. As I mentioned at the start of this presentation, the US has incredibly strong relationships with the global banking system. So if you do come onto their radar and you've been holding assets that will be taxed punitively, or you haven't been disclosing, there's a very realistic chance that they can find out about that. If you are honest and forthcoming and attempt to correct the situation, they're usually very generous, and they know that this is quite an unusual situation for people living abroad, and it's quite an unusual tax regime compared to other countries. So the first thing to do is to create an inventory list of all the accounts, what's inside them, any account wrappers, who manages them, who technically owns them. Are they in your name? Are they in your husband's name? Are they in a joint account? Try to maintain, obviously, the cost basis to the best of your ability. Work out what cost when you originally bought it in both currencies at that time's FX, and try and sort of localize exactly where the problem is and what needs to be fixed. Because actually, when you look at the whole plan, it might be that this is a very, very tiny issue on a much bigger, perfectly created balance sheet. The next step is specialist tax review. There really isn't a replacement for formal US UK tax advice, which is why I don't attempt to give it. It's not my expertise. If you are in this position and it looks like there's going to be a costly tax bill, it is definitely worth reaching out to a reputable US UK tax advisor for an assessment of what the correct way forward is. Next step is obviously don't continue to add to the problem. This seems obvious, but particularly where people have sort of automatic cash sweeps that go into certain accounts, auto investors, you want to stop those. Obviously, don't continue buying something where the returns will be so cannibalized by tax that you will lose money. And then finally, obviously, come up with a transition plan. Just because you've discovered it doesn't mean it needs fixing today. And the objective is a long-term or a medium-term transition to something that looks a little bit better. This is, the follow-on sort of from that question. How do I unwind without creating a bigger bill? So localize the issue, try and find out exactly what's happened, particularly with a PFIC. The history and reporting is really important. There are actually ways that you can go through the history of how a PFIC has performed, and provide that information to an accountant where they can take a sort of sympathetic view on how it should be taxed. It is possible. It's not always easy. Figure out cost basis and then prioritize. So which is the biggest problem? Are there any losses to offset with this gain that's going to be taxed at a really high rate? Consider concentration and liquidity. Just because you're trying to fix a tax problem doesn't mean that it makes sense to completely destroy your broader investment plan, whereby, say, your life savings are all sat in one safe asset that's taxed appropriately. Because obviously, in a market downturn, you will lose a significant amount of money. So try and prioritize the risk with the tax with the goals of the investment strategy. Consider the filing deadlines. These are Googleable. You can request extensions, and any reputable US UK tax advisor will be able to tell you pretty quickly how fast or slow you need to move. And then said transition plan, finally, think about donations. If you have a PFIC with large embedded gains, there is often an opportunity for you to give that as part of your long-term philanthropic plan. If you are always going to make a gift or a donation to a particular charity, maybe this is a good opportunity to sort of kill two birds with one stone. And then this is a question that happens that comes to me quite a lot, and something that I delight in answering. Does a smaller investment universe mean worse outcomes? If you have an appropriate professional advisor who is an expert in the topic, it doesn't need to be. The constrained investment universe will limit opportunities if you don't know what you're looking for and you don't know how to create an investment plan. And it is very tempting to buy things that aren't necessarily the highest return investments just because they feel safe. But if you have knowledge and skill, or if you've employed somebody who has knowledge and skill to invest on your behalf, you should have a portfolio that performs the exact same as is performance unconstrained when compared to somebody with less tax complexity. There are a lot of options out there. You just need access, knowledge, skill, ability to find them. Also incorporate, wherever possible, some bullet points at the bottom. Household balance sheet to create diversification, which I mentioned. Always consider after-tax return and reporting costs. Those reporting costs can really, really creep up. If relocation is a possibility, even a small possibility, try and ensure that you have flexibility with the investment plan. The portfolio doesn't need to be any more complex than anyone else's, and expert professional advice. There is really no replacement for that. And then one thing that you can do this week is to create a cross-border spreadsheet for the entire household. Even if you don't think you've got any tax problems, this is just really good hygiene, financial hygiene. So think about accounts, owners, wrappers, legal vehicles, especially consider things like trusts, or where you are the beneficiary of a trust that you don't have a huge amount of knowledge of. That is still relevant. The holdings within any fund, any tax wrapper, any account, do you have the cost basis in GBP and USD with the relevant tax lots? If not, can you get them? How difficult will that be? Currency, so your exposures to currency through the lens of future spending. So if you have future liabilities, for example, in dollars, then you likely want to have some currency exposure to dollars, ideally in your stability bucket. So that would be sort of cash and very low risk fixed income. Reporting, both the reporting requirements and the advice. Do you have a good US UK tax advisor, investment manager, and probably also lawyer for when you're thinking about things like wills and estate planning, and who is responsible for your next question. So that was everything from me. My details are available from Lottie and on the Juris Society's network of professional advisors. If anybody would like to have a conversation about a situation that they're concerned about, or if you just have a question, then please do get in touch with me.
Olivia, thank you so much. That was such an informed presentation. I think one of the things we would try to do with the Essential series is to show all our members how much peace of mind and how much empowerment comes from having access to the right information and access to the right advisors. And I honestly think, nothing conveys the importance of having highly qualified, highly experienced professionals on your team, quite like the nexus between US and UK tax and finance. Thank you very much. If we're not opening the presentation to questions, But I would say that for anyone watching this, if Olivia's presentation resonates, if there's anything that's concerning you, do drop her a line directly. And likewise, if you want to know more about the Dura Society, you can find us at thedurasociety.com or LinkedIn or Instagram. Thank you, everybody, for joining us today, and stay tuned for the next Essential series. Have a good one.